Picture this moment in financial history. Someone sits, staring at the CME Group delivery report, and the numbers staring back tell a story that should make every person who understands markets sit up and take notice. The exchange just issued delivery notices for over 1,000 contracts in a single session, representing nearly 6 million ounces of silver that suddenly got claimed by someone who wanted the actual metal, not just the paper promise of it. But that's just the opening act of something far bigger. When you pull back and look at just the first 48 hours of the new year, combining what happened on New Year's Day with this latest surge, the total demand for physical delivery reaches a staggering figure that seems almost impossible to believe. Over 3,000 contracts standing for delivery, each one representing 5,000 ounces of the white metal. Do the math, and you're looking at more than 17 million ounces of physical silver that changed hands in just 2 days. To put this in perspective, the entire global mining industry produces roughly 800 million ounces annually, which means in the time it takes most traders to shake off their holiday hangovers and return to their desks, the exchange had to cough up approximately 2% of the world's entire annual production. This isn't the normal flow of business. Factories don't suddenly order 17 million ounces on a quiet Friday afternoon. Commercial hedgers don't move like this. What we're witnessing looks more like a sophisticated, coordinated assault on the exchange's physical inventory, and the timing couldn't be more telling. The sharks in the financial waters didn't randomly pick these dates. They waited specifically for the first trading days of the year, and there's a reason for that calculated patience. As of this week, new regulations in Beijing have fundamentally altered the landscape of the global silver market. China has restricted silver exports to only a select group of licensed firms, effectively cutting off the flow of swing metal from the east. The Western financial institutions saw this wall going up and understood what it meant. The roughly 40 million ounces sitting in registered vaults represented the last easily accessible pool of physical metal on the planet. Once those ounces disappear, there's no safety net, no backstop, no Shanghai arbitrage window to exploit because the metal simply cannot leave China anymore with any ease. So rather than testing the waters carefully, these sophisticated players went all in. They demanded delivery of 17 million ounces almost instantly, stripping nearly half the available liquidity in just 2 days. If this pace continues for even another week, the mathematics of the situation become impossible to sustain. The exchange cannot survive another 10 days of this kind of pressure without either defaulting on its obligations or fundamentally changing the rules of the game. What appears on the surface to be a normal trading session is actually an inventory liquidation event happening in real time. The truly frightening aspect isn't just the sheer volume of metal moving, it's what that movement represents. Back in 1980, when something similar happened, it was two brothers from Texas trying to corner the market through sheer audacity and wealth. Today's situation involves a completely different set of players. The banks themselves are executing this strategy, and what makes it particularly significant is that it signals the end of an era. For decades, these institutions worked together, maintaining an unspoken agreement to keep prices suppressed. That gentleman's agreement appears to have shattered completely. Now we're seeing something that looks more like cannibalization. The major players are no longer cooperating to hold prices down. Instead, they're turning on each other in a desperate scramble to secure what remains. When you examine the data showing who sold the silver and who bought it, a brutal war becomes visible behind the scenes. Usually, these banks pass metal back and forth like they're playing hot potato, keeping the game going without anyone actually removing metal from the vault. But something fundamental changed. The music stopped and the potato froze in midair. The metal stopped moving in circles and started moving in a straight line, flowing out of one institution's vault and into another's fortress. One major player was forced to bleed millions of ounces of inventory that they desperately needed to keep. Another major institution, formerly their ally, stood ready with a bucket and caught every single drop. This is what happens when a currency system begins to fracture. The thieves stop stealing from the public and start stealing from each other. Looking at the registered inventory provides even more insight into the crisis unfolding. The exchange releases daily reports on silver stocks in their warehouses, divided into two categories. Eligible metal is privately owned and stored in the vault, but not available for sale at current prices. It's essentially parking. Registered metal has a warrant attached and is available for delivery to settle futures contracts. It's the metal with the for sale sign attached. As of the close of business recently, the registered category had dropped to just over 39 million ounces. In a single 24-hour period, nearly 3 million ounces withdrew from the registered category, and that's just the beginning of the settlement process for the 17 million ounces that were demanded. This reality explains why the price held around $72 despite all this volatility. The physical floor keeps rising because the physical foundation keeps disappearing. Interestingly, the immediate market reaction was relatively muted. Silver closed up slightly but didn't explode to triple digits overnight. The reason for this delayed response is that delivery operates as a silent killer. When someone buys a futures contract, It shows up on the tape instantly and makes noise. When someone stands for delivery, it happens in the back office. The impact isn't felt until the metal actually leaves the vault and the seller realizes they cannot replace what they just gave away. We're currently in what could be called the lag phase. The raid has already happened and the metal has been claimed, but the broader market hasn't fully absorbed the reality that the inventory is gone. This creates an enormous opportunity for anyone paying attention. It's like seeing the crime scene before the police arrive, knowing the vault is empty before the news reports it. While retail traders argue about whether current prices represent a double top on their charts, the truly informed money is backing up armored trucks to the loading dock because they understand this isn't about chart patterns, it's about possession. But knowing metal moved and understanding the historic volume only tells part of the story. The question of who exactly was fighting, who lost the metal, and who claimed it reveals the real drama. When you examine the specific data, names emerge. Deutsche Bank appears as the primary issuer, forced to deliver over 3 million ounces in a single day. Deutsche Bank has been considered the sick man of European banking for a decade, with a fragile balance sheet. It appears the other sharks smelled blood in the water and decided to strike. On the other side, the stoppers who demanded the physical metal include two massive names: Citigroup and the undisputed king of the silver market, JP Morgan. Combined, these two entities stopped over 4 million ounces. This wasn't market making or routine hedging. JP Morgan already holds the largest physical stockpile in the world. They bought this metal to corner the market, seeing the same data everyone sees but acting on it with ruthless efficiency. They know the mines are running at capacity. They know the Chinese export ban is real and enforceable. So JP Morgan decided to take the remaining liquidity from a weaker rival, draining Deutsche Bank to fill their own fortress. This raid signals they've switched from net short to net long on physical metal. They're finished accumulating. Now they're tightening the screws, and by draining the exchange of 17 million ounces, they're effectively forcing prices higher. They're front-running the revaluation they know is coming. They understand silver is heading toward triple digits, and they want to own the physical metal when that happens, not hold paper liabilities. They're cashing out of the fiat system and moving into hard assets. When the biggest bank in the United States starts raiding silver vaults with this intensity, it signals something profound about the dollar's future. While JP Morgan was securing millions of ounces, what could ordinary investors buy? Essentially nothing. Monitoring the inventory feeds of major online dealers reveals that the retail supply chain has suffered catastrophic failure. One of the largest volume dealers in America recently displayed a terrifying message on their product page for current year American Silver Eagles, out of stock. But the situation gets worse. Usually when dealers run out of stock, they provide an estimated shipping date of perhaps 2 weeks. Instead, the estimate showed the next shipment arriving in March. We're in early January. They're telling customers that for the next 8 weeks, zero inventory is coming in. Why this complete drought? Because the US Mint cannot obtain the silver blanks they need to strike coins. And why can't the Mint get blanks? Because JP Morgan just bought all the silver bars the Mint uses as feedstock. The whale ate the food supply, and now the Mint is starving. Other major dealers show the same pattern. Some don't even display prices anymore, just grayed out boxes showing unavailability. They're not even taking back orders, which is significant because dealers usually love back orders. It's an interest-free loan from customers. When a dealer refuses to take money for future delivery, it means they're terrified they won't be able to source the metal at any price. They're afraid of defaulting on customers, so they're choosing to shut down sales rather than take that risk. One dealer known as the last resort, the one that always has metal because they charge the highest premiums, does currently have some Eagles in stock. But look at the price. A single random year American Silver Eagle is listed at nearly $90. The COMEX spot price where banks trade is $71. That's an $18 premium, a 25% search charge just to hold metal in your hand. For brand new mint condition coins, prices approach $95. This is bifurcation in its rawest form. JP Morgan pays $71 because they buy 4 million ounces. Regular investors pay $89 because they buy 1 ounce. The wholesale discount has become a retail tax. Even generic rounds and junk silver, the old pre-1964 dimes and quarters that nobody used to want, are trading at 40% premiums over melt value. There is no cheap silver left anywhere. If you're waiting for a dip to buy, you're looking at the wrong chart. The paper chart might dip tomorrow if banks play games, but the physical price at dealers isn't going to 65. It's heading to 90, then 100 because the supply is gone. You cannot buy what doesn't exist regardless of what charts say. But silver is a global asset. While the US retail market broke and the wholesale market got raided, what about the rest of the world? The inventory reports from the Shanghai Futures Exchange reveal that while New York was bleeding, Shanghai was hemorrhaging. They lost 46 tons of silver in a single day. This connects the bank raid in New York to the export ban in China. It's a synchronized global event. The West is draining the West. The East is draining the East. and the middle is empty. Looking at the global picture creates a terrifying calculation. New York is bleeding nearly 3 million ounces daily. Shanghai is bleeding 1.5 million ounces daily. That's roughly 4.5 million ounces of physical silver vanishing from visible stockpiles every single day. Meanwhile, the global mining industry only produces about 2 million ounces daily. The world is running a daily deficit of 2.5 million ounces, consuming more than twice what it produces. The mathematics are fundamentally broken. The buffer is gone. The exchanges are running out of product in real time. This explains why JP Morgan moved with such urgency. They see these numbers before we do. They have intelligence watching trucks in Shanghai and contacts in refineries. They saw the Shanghai drain starting and watched COMEX levels dropping. They realized if they didn't grab metal from Deutsche Bank immediately, there wouldn't be any metal left next week. This wasn't a trade. It was a preemptive strike to secure supply before Chinese demand could suck it across the ocean. Signs of this inversion are creeping into London markets as well. This curve inversion is rare and historically significant. It happened in palladium before that metal reached $3,000. It happened in rhodium before that metal touched $29,000. Now it's happening in silver, and the curve is screaming danger. Traders in New York are looking at charts and dollar indexes and Fibonacci retracements, completely unaware of what's happening on the ground in Chinese industrial centers. They think silver is a currency play. China knows silver is a strategic technology metal. The West is selling paper silver at $71, thinking it's expensive. The East is buying physical silver at $80, knowing it's cheap compared to the cost of shutting down a gigafactory. This is the great wealth transfer happening in real time. Every ounce sold on the COMEX at 71 is being absorbed, refined, and shipped to warehouses where it will never be seen again. We're selling our strategic resources to pay for consumer goods, and when the vault is empty, the mistake will become painfully obvious. But it will be too late. So why did Deutsche Bank fold? Why deliver metal instead of fighting back? Deutsche Bank has struggled for years with a massive derivative book and legal issues. They're the weakest link in the global bullion chain. It's highly likely they were short silver, and when prices spiked, they got a margin call. Unlike JP Morgan with infinite cash access, Deutsche Bank might have been cash constrained on that specific trading desk. So they gave up their physical inventory to close the position. They surrendered their lifeboats. Now, Deutsche Bank is flat, out of the physical game, while JP Morgan is long and dominant. Running the mathematics on this transaction reveals something crucial. JP Morgan and Citigroup combined took delivery of over 4 million ounces. At $71 per ounce, the total cost of this raid was roughly $314 million. To ordinary people, that's an unimaginable fortune. But to JP Morgan, which currently holds $1.65 trillion in Tier 1 capital, $314 million represents 0.02% of their safety buffer. It's the financial equivalent of buying coffee. It doesn't dent their balance sheet, doesn't threaten solvency, doesn't trigger regulatory margin calls. If you're waiting for JP Morgan to collapse because they spent $300 million on silver, you'll wait forever. They have access to liquidity that's essentially unlimited. But here's the critical insight. If the cost was so negligible, why did they do it? Why break the unspoken truce with Deutsche Bank? Why drain registered vaults to dangerous levels? Why risk creating retail panic? Because while they have infinite dollars, they know there's finite silver. They raided the market not because they had to spend the money, but because they had to secure the metal. They know the $314 million spent today bought 4 million ounces, but next week that same amount might only buy 2 million ounces, and next month it might buy nothing. This proves the crisis isn't about solvency. It's about availability. It's a physical lockout. The banks are converting worthless paper fiat, which they can create freely, into the only asset that China, Samsung, and Tesla are fighting over. They're swapping fake assets for real assets at a speed unseen since 1980. They're not dumb money getting squeezed. They're ruthless money doing the squeezing, front-running the inevitable revaluation. For 40 years, we've called the banks the cartel and accused them of suppressing prices. They did suppress prices, but why? To accumulate. You suppress prices while buying. But once you're full, once you've drained the vault and secured supply, you have no incentive to keep prices down. In fact, you have every incentive to let them rise. If JP Morgan now holds hundreds of millions of ounces of physical silver and has closed short positions, do they want silver at 71 or at 200? They want revaluation of their new asset. This is the pivot. We're likely to see banks stop fighting the trend and start fueling it, using algorithms to squeeze remaining shorts, becoming the engine of the bull market. When Asian markets open and China sees this delivery report, they'll interpret it as resource warfare. The West is securing metal. This will trigger panic in Shanghai. If we don't buy now, Americans will take it all. Expect a violent opening as Shanghai traders try to front-run the New York Open, widening the arbitrage spread even further. The bank raid has poured gasoline on geopolitical fire. The final verdict on this 17 million ounce raid is clear. It was a heist, the day big banks realized the game was ending. They stopped pretending the market was liquid, took the metal, and ran. The vaults are empty. Retailers are sold out. The East is hoarding. The West is raiding. And the price sits at $72 for now. This is the calm before revaluation. The metal is gone. The squeeze is here. Welcome to the new world.